Something historic is happening right now, and almost nobody is talking about it the right way. This is not a market fluctuation. This is not a portfolio rebalance. This is not about yields. This is about power. Because China is quietly walking away from the United States financially. And the consequences are going to hit every American household. Let's start with the number that should stop you in your tracks. At its peak, China held over $1.3 trillion in U.S. Treasury debt. As of January 2026, that number has been cut nearly in half, down to $682.6 billion. And this didn't happen by accident. This was deliberate, it was strategic, and it was done knowing it would cost China money. That's the part most people miss. The hidden deal that powered America. For decades, there was an unspoken agreement between China and the United States. America consumed, China produced. America ran deficits. China recycled those trade surpluses back into U.S. Treasuries. This kept U.S. interest rates low. It kept borrowing cheap. It allowed Washington to spend without consequence. Mortgages stayed affordable. Credit cards stayed usable. Government deficits didn't immediately explode the system. Oh, that was not magic. That was China. China was the largest foreign buyer of U.S. debt. They were the silent engine behind America's ability to live beyond its means. And now that engine is shutting off. Why this is not about money anymore. Here's the key point. China is selling treasuries at the worst possible time financially. They're dumping low-yield bonds into a high-interest rate environment. That guarantees losses. No rational portfolio manager would do that, unless the goal wasn't returns, unless the goal was independence. This is not China optimizing yield. This is China eliminating vulnerability. The moment trust died. The turning point wasn't inflation. It wasn't tariffs. It wasn't politics. It was 2022, when the United States froze Russia's foreign reserves. Over $300 billion gone with the stroke of a pen. That moment changed everything, because it sent a message to every nation holding dollar assets. Well, these aren't really your reserves. They're ours until we decide otherwise. China heard that message loud and clear, and from that moment on, U.S. Treasuries stopped being safe. They became a political liability. The shift to hard assets. So where did the money go? Gold. Physical gold. Over the last 14 months, China has accumulated over 2,300 tons of gold. That's not diversification. That's preparation. Gold cannot be frozen. It cannot be sanctioned. It cannot be printed. It exists outside the political system. And that's exactly why China wants it. This isn't speculation. It's policy. Decoupling is no longer a theory. At the same time, China is selling U.S. debt. It's doing something else. It's building self-reliance. Massive investment into domestic semiconductor production, green energy infrastructure, strategic metals, AI, and advanced manufacturing. The goal is simple. Never again be dependent on U.S. financial or supply chain leverage, and tariffs accelerated this process. Why support an economy that is actively trying to contain you? A parallel system is already live. This is where things get serious. China didn't just walk away from treasuries, it helped build an alternative. Through the BRICS alliance, a new trade settlement system is already launched. It's called the Unit, and it's partially backed by gold, energy trades, commodity trades, strategic materials, all settling outside the US dollar, outside SWIFT, outside American oversight. This isn't a future plan, it's operational. What this means for the US? Immediately. When the largest buyer leaves the market, prices move. And in bonds, price movement means yields. Treasury yields go up. That's not abstract, that hits real life. Mortgage rates rise, auto loans get more expensive, credit card interest explodes, government borrowing costs skyrocket. And unlike past cycles, there's no China waiting to step in and stabilize the market. The Fed is trapped. Here's the problem. High rates break the economy, low rates reignite inflation. So what happens when yields spike and the system starts cracking? The Fed steps in, it prints money, it buys bonds. This is called yield curve control, and that's inflationary. So you get the worst of both worlds. High prices, high debt. Weak growth, sticky inflation that won't go away. Banks are already under pressure. Remember 2023 regional bank failures? That wasn't about bad loans. That was about bond losses. Banks hold massive portfolios of long-term treasuries. When yields rise, bond prices fall. Those losses are still sitting on balance sheets. Unrealized, for now. China exiting accelerates that stress, and stress spreads. This is only the beginning. China's move isn't the end. It's the opening shot, a signal to other nations. You don't need to fund U.S. deficits forever. You don't need to hold paper promises. You can choose sovereignty, and some already are. This is the birth of a multipolar financial world. More currencies, more settlement systems, more competition, less US dominance, and that has consequences. We'll talk about what this means for your money, how Americans will feel this directly, and what the smart response looks like in part 2. Now, let's bring this home. Because China's financial divorce from the United States is not an abstract geopolitical story. It shows up in your mortgage, your grocery bill, your retirement account, and your job security. The end of cheap credit. For good. For 40 years, Americans lived in a world of falling interest rates. Every crisis was solved the same way. Lower rates, print money, kick the can. That era is over. And China walking away from US debt makes sure of it. Without a massive foreign buyer absorbing treasuries, rates don't gently drift lower. They stay structurally higher. That means mortgages done T to us go back to 3%. Auto loans done T normalize. Credit card debt becomes suffocating. Small businesses choke on financing costs. This isn't T a cycle, it's a regime change. Why inflation 1, T die? People keep asking, why isn't it T inflation going back to 2%? This is why. The Fed is trapped between two impossible choices. Let yields rise, break banks and housing, or cap yields, print money, fuel inflation. China exit, removes the pressure release valve. There's no external buyer to stabilize the system, so inflation becomes sticky, not hyperinflation. Worse, persistent erosion, 4%, 5%, year after year, slowly draining purchasing power while wages fall behind. The silent tax on savers. Inflation isn't just rising prices, it's a tax on cash, bonds, fixed income, anyone playing it safe. And here is the cruel irony. U.S. Treasuries, once the ultimate safe haven, are now part of the risk. If yields rise, bond prices fall. If the Fed prints, inflation eats returns. Heads you lose, tails you lose. That's why China left. They did the math. Shadow moves you. You're not supposed to see here something most headlines want to tell you. China didn't just sell treasuries directly, they also moved holdings through. Belgium, Luxembourg, European custodial hubs. Why? To obscure exposure, to avoid being targeted, to create distance from U.S. financial retaliation. This is how sovereign financial warfare is fought now, quietly, indirectly, relentlessly. Paper promises versus real assets. And this brings us to the heart of the shift. The world is redefining what safe means. For decades, safety meant yield. Paper assets, government guarantees, trust in institutions. Now, safety means control. Assets that can T be frozen, can T be printed, can T be sanctioned, can T be defaulted on. That's why gold is being accumulated. That's why silver is being hoarded. That's why critical minerals are becoming national security assets. A multipolar world is not coming, it's here. This is not the collapse of America, but it is the end of American financial monopoly. The dollar will still exist, but it won't dominate unquestioned. Trade will settle in. Regional currencies, commodity-backed systems, bilateral agreements. The U.S. will no longer be able to export inflation freely, and that changes everything. What this means for you, personally. So what do you do with this information? First, understand the shift. The old playbook doesn't work anymore. Blind trust in bonds, cash, institutions is no longer enough. Second, diversification isn't optional, it's survival. That doesn't mean panic, it means realism. Holding some assets outside the paper system, assets that don't rely on promises, assets that exist regardless of politics. Gold, silver, hard assets, not as speculation, as insurance. The era of complacency is over. China didn't sell U.S. debt because it hates America. It sold because it no longer trusts the system. And trust, once broken at the sovereign level, doesn't come back quickly. This is a slow-motion shift, but it's irreversible. Those who adapt early preserve purchasing power. Those who ignore it pay the price quietly, over years. Final thought. The world is changing how it defines wealth. Not by returns, but by resilience. China saw that first. Now the rest of the world is catching up. The only question is, will you? If this breakdown helped you see the bigger picture, share it. Stay informed. And remember, the most dangerous moment in finance is when the old rules stop working and people pretend nothing changed.